Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines.
Let's dive in.
We've got some pretty wild stories today impacting the markets.
Oh, yeah.
Yeah, we're looking at the Wall Street Journal, CNBC, and Bloomberg.
Sounds like it'll be a busy one.
First up, Florida seems to have accidentally banned banks from selling investments in the state.
Whoa. How do you accidentally do that?
Well, the Wall Street Journal saying it all goes back to this new law. It was supposed to protect Floridians from, bad actors.
Right, trying to keep investors safe.
Exactly. But the way they wrote it, it kind of backfired. The law was trying to help startups raise money more easily and prevent people with a criminal history from taking advantage of investors.
Ah, so good intentions, but maybe not the best execution.
Yeah, pretty much. It ended up looking like it prohibited any bank with any past SEC violations from selling, well, a bunch of different securities.
So that's a lot of banks, right?
Oh, yeah. I mean, almost every major bank has had some sort of regulatory run-in at some point.
So this isn't just impacting small players then. We're talking big names in finance.
Absolutely. JP Morgan Chase and Bank of America even had to temporarily halt operations.
Wow.
And it could have even impacted massive hedge funds like Citadel and Elliott Management. They have a pretty big presence in Florida.
So what's Florida doing about this? Seems like a pretty big oversight.
Luckily, they've already taken some steps to fix it.
Oh, good.
Yeah, they used those emergency powers they put in place for the recent hurricanes and temporarily suspended the problematic part of the law.
That's a relief, but it's not a permanent fix, right?
No, definitely not.
Yeah.
The Florida legislature has to come up with a permanent solution now. And the Wall Street Journal pointed out this isn't their first legislative hiccup.
Oh, really? What else have they done?
Well, just last year, they tried to cool down the housing market, right? So they restricted foreign property ownership, but they ended up accidentally shutting out Chinese-backed funds.
Seems like a pattern of well-intentioned laws with some pretty big unintended consequences.
For sure. It makes you wonder what will happen when they try to fix this bank ban permanently.
Yeah, are we going to see another unintended consequence?
Who knows? Only time will tell. But it's definitely a situation worth watching.
For sure. I mean, it raises some interesting questions about the balance between protecting investors and, fostering a healthy business environment.
Couldn't agree more. Now, speaking of Florida, let's turn our attention to a potential power duo with plans to shake up federal spending.
Oh, this should be good.
The Wall Street Journal is reporting that billionaire investor John Paulson, who's a close ally of former President Trump, has said he'd serve as Treasury Secretary in a second Trump term.
That's a big name in finance. What's his plan?
Well, he wouldn't be going at it alone. He's planning to collaborate with, get this, Elon Musk.
Really? Wow, that's an interesting pair. Paulson, the finance veteran, and Musk, the tech disruptor. I'm curious to see how those two would approach government spending together.
Me too. Paulson outlined a two-pronged strategy. First, he said he'd push to extend the 2017 tax cuts from Trump's first term.
Right, that aligns with traditional Republican economic thinking, stimulate growth through tax relief.
Exactly. And then he'd team up with Musk to go after those green energy subsidies in the Inflation Reduction Act.
Interesting. That's a pretty significant departure from current policy.
Oh, absolutely. And Paulson even called it the Green New Deal. So I think we can get an idea of his stance there.
I think so. And what about Musk? What's his role in all of this?
Well, he's claiming he can find at least $2 trillion in potential budget cuts.
$2 trillion! That's massive. That would require some pretty radical restructuring of government spending.
No kidding. But Paulson's plan doesn't stop there. He also said he wants to advocate for increasing U.S. energy production and potentially implementing something he called strategic tariffs.
That sounds like a pretty protectionist approach, shielding U.S. industries from foreign competition.
Yeah, it seems that way. He even suggested using these tariffs as leverage to encourage companies like Deere & Co. to keep their manufacturing here in the U.S.
So using tariffs as a bargaining chip. Interesting. Could be effective, but it could also lead to higher prices for consumers.
Definitely something to keep an eye on. It seems like Paulson's vision for the Treasury extends beyond the typical duties. He wants to impact energy and trade policy as well.
That would be a very active and probably pretty controversial approach to managing the U.S. economy.
You got that right. Now let's switch gears from politics to precious metals for a minute.
Okay, what do we have?
CNBC is reporting that gold prices have hit a record high.
Really? I guess that's not too surprising. It's a classic signal of market uncertainty, right?
Exactly. Investors tend to run to gold as a safe haven when they get nervous about the economy or, geopolitical events.
Makes sense. So, what's driving this particular surge?
Experts are pointing to two main factors: anxiety over the upcoming U.S. election and the possibility of more rate cuts by the Federal Reserve.
Ah, a close election always brings volatility. And if the Fed cuts rates again, holding gold becomes even more attractive.
Yeah, because gold doesn't earn any interest, right? So when interest rates are low, there's less of an opportunity cost to holding it.
Makes sense.
CNBC is also saying to watch for those big economic reports coming out this week. Things like the ADP employment report, PCE inflation, and especially Friday's jobs report.
Right. Those will give us a better picture of what the Fed might do next.
Exactly. If the economy's looking strong, the Fed might decide to hold off on cutting rates. And that could potentially dampen the, what did you call it?
The gold fever.
The gold fever, right. But even with this recent surge, Goldman Sachs is still bullish on gold. They're predicting it could climb even higher.
Wow, they're really betting on continued uncertainty then.
It seems that way. Now let's switch gears again, this time to the auto industry.
Okay, what's going on there?
Bloomberg is reporting that Volkswagen, the big German car maker, is facing some serious headwinds.
Interesting. What kind of headwinds are we talking about?
Well, they just reported their lowest profit margin since the pandemic. It really highlights those challenges that traditional car makers are facing.
Yeah, the whole auto industry is going through a major transformation. Electric vehicles, self-driving technology, new companies like Tesla. It's a whole new ballgame.
And Volkswagen seems to be getting hit from both sides. They're dealing with slumping sales in China, which is a huge market for them, and fierce competition in Europe, their home turf.
It's tough out there for the established players. Those Chinese automakers are coming on strong, especially with electric vehicles.
And it's gotten so bad that Volkswagen is considering closing factories in Germany for the first time ever.
Wow, that's a big deal. I can't imagine the unions are happy about that.
No, not at all. But the Volkswagen brand has set a pretty ambitious goal of cutting costs by over 10 billion euros. They're really trying to catch up to their competitors.
10 billion euros is a lot of money. It sounds like they recognize the need for some major changes.
Yeah, it's definitely a crucial moment for them. They're going to have to adapt quickly and embrace these new technologies if they want to stay in the game.
Absolutely. The auto industry is going through a seismic shift, and Volkswagen is right in the middle of it.
No kidding. The decisions they make in the next few months could make or break them.
It's a fascinating case study in how even industry giants need to evolve to stay ahead of the curve.
Speaking of evolution, let's jump to AI for a sec. The Wall Street Journal says KKR and Energy Capital Partners are teaming up for a massive investment.
How massive are we talking?
$50 billion.
Whoa, that's a serious chunk of change. What are they putting it into?
AI, but not just the AI itself, more like what it needs to grow. Think data centers, power generation, that sort of thing.
Makes sense. I mean, AI uses a ton of energy, right? We're already seeing it put a strain on power grids.
Exactly. Doug Kimmelman, the founder of Energy Capital Partners, even said the capital needs are huge, and one of the big bottlenecks, maybe the bottleneck, is electricity availability.
Yeah, he's got a point. Even those big tech companies are having trouble keeping up with the demand, especially if they want to, stick to those sustainability pledges they've made.
It's a tough spot, right? Prioritize progress, even if it's not the greenest solution, or risk falling behind while you search for something better.
No easy answers there. Although McKinsey, the consulting firm, says the need for data centers is kind of overshadowing those sustainability concerns for now.
It's a practical approach, but hopefully just a temporary one, until we find some better ways to power all this AI growth.
Fingers crossed. Now let's switch gears a bit and talk about Norway. Bloomberg has this interesting story about how they're handling their oil wealth.
What are they doing? Giving it all away?
Not quite, but they are turning to their citizens for advice. They launched this public consultation thing, asking Norwegians how they think the country should use its oil fund. It's officially called the Government Pension Fund Global.
A public consultation. That's a pretty democratic way to handle a $1.4 trillion fund.
Yeah, and it's not just any fund. We're talking about 1.5% of all globally listed company shares. That makes them a major player in the financial world.
Wow, so they're not just asking for opinions, they're asking for input on how to manage a huge chunk of the global economy.
Pretty much. The idea is to get different perspectives on how to manage the fund ethically and financially.
Right, because it's not just about making money. It's about considering the long-term impact of those investments,
Yeah.
especially with climate change and, well, everything else going on.
Exactly. It'll be interesting to see what comes out of these consultations. It could be a model for other countries with a lot of natural resource wealth.
Maybe so. Let's jump back to the U.S. now and talk about the dollar. CNBC says its recent rally has stalled out.
I guess that makes sense with the jobs report coming up on Friday.
Right. Everyone's holding their breath to see what the numbers look like.
It's the biggest economic indicator, so yeah, I get it.
Well, the dollar had been doing really well, actually. Hit a 3-month peak earlier this week. But I guess those mixed economic reports are making investors a bit hesitant.
So they're waiting for some more clarity before making any big moves.
Seems like it. That jobs report is going to be crucial in figuring out what the Fed will do next.
No doubt. Strong numbers, and they might hold off on more rate cuts. But if it's weak, well, they might have to think about more stimulus, which could weaken the dollar.
It's a waiting game. Now, while we're on the topic of currencies, CNBC also mentioned that the Australian dollar has taken a hit.
Oh, really? What happened there?
Their inflation data showed a slowdown, which is making people think the Reserve Bank of Australia might not raise interest rates after all.
Ah, makes sense. Central bank decisions always have a big impact on currencies.
For sure. Now, for a little political intrigue, Bloomberg has a story about Ken Griffin. He's the billionaire founder of Citadel, and he made a pretty bold prediction at that Future Investment Initiative Summit in Saudi Arabia.
Ken Griffin, huh? He's not one to mince words. What'd he say?
He's predicting a Trump win in the election.
Wow. That's a big statement, especially coming from him. He's usually pretty spot on with his predictions.
He did say the race is super tight, called it almost a coin toss. But in the end, he thinks Trump will pull it off.
Well, we'll have to see about that. But I guess his prediction reflects what some investors are thinking. They seem to think a Trump win would be better for the markets.
Interesting. Meanwhile, other big names like Goldman Sachs CEO David Solomon and BlackRock's Larry Fink have also been talking about the election. They're really emphasizing how important it is for the economy.
Everyone's trying to figure out how the results will impact their investments. It makes sense.
Speaking of investments, Bloomberg says U.S. equity futures are all over the place. Investors are trying to digest all these corporate earnings reports.
Yeah, it's always a roller coaster ride during earnings season.
It's been a mixed bag so far. Alphabet, Google's parent company, saw their stock jump over 5% after the beat earnings expectations.
Not bad. What drove that?
Their cloud computing division seems to be doing really well.
That's good news for them. Shows they're still finding ways to grow.
But not all the tech companies are having such a good time. AMD, or Advanced Micro Devices, saw their stock dip after they gave a pretty weak revenue forecast.
Right, because even in a hot sector like tech, there are always going to be winners and losers.
And then there's Eli Lilly. Their stock took a huge hit, like 10%, after sales of their weight loss drug didn't meet expectations.
Ouch, yeah. That's the risk you run when so much depends on one product.
It's a lot to keep track of. Earnings reports, economic data, not to mention the election.
And it's not over yet.
Yeah.
We've still got reports on GDP, ADP employment, pending home sales, and personal income and spending all coming out today.
Busy week, for sure.
We said it. Now, before we move on, I wanted to touch on something MarketWatch brought up about stocks and bonds.
Oh yeah, what did they say?
Well, they're pointing out that stocks are pretty expensive right now compared to bonds, which, historically speaking, is kind of unusual.
So people are paying a premium for stocks, even though they're considered riskier than bonds.
Exactly. The strategists over at UBS say it's all about the equity risk premium. Basically, that's the extra return investors want for holding stocks instead of those super safe government bonds.
So if stocks are riskier, why are investors willing to accept lower returns for them?
Seems like they're seeing stocks as less risky than usual at the moment. The equity risk premium is actually at its 15th percentile, and that's based on a 100-year distribution. So, yeah, stocks have rarely been this pricey compared to bonds.
Interesting. So what's the UBS team saying about all this?
They think it's about to change. They're saying we're entering this new era, one with more deglobalization, less policy flexibility, and more geopolitical risks, all of which means the equity risk premium is probably going to go up.
Meaning investors will want higher returns for those stocks.
Yep, exactly. All that uncertainty and volatility makes people want to play it safe, so they go for those bonds.
Makes sense. And what about those corporate profits? I remember you mentioning that a while back.
Right. Well, UBS is pointing out that those profits are super high compared to GDP, higher than usual, which makes them think it's not sustainable in the long term.
Ah, so that could also lead to a shift back towards bonds.
Could be. If profits start to drop, stocks are going to look less appealing.
Interesting. So they're basically saying things are going to shift. Stocks might not be the golden child for much longer.
That's the gist of it. And they specifically mention U.S. growth stocks as being potentially overvalued.
Something to think about for sure. It's always good to get different perspectives on things like this.
Definitely. It's food for thought for anyone trying to navigate these crazy markets.
Now, remember that Florida bank ban we talked about earlier?
Oh, yeah, Florida's accidental ban. Can't forget that one.
Makes you wonder what's going to happen next. Will they actually be able to fix it this time?
The Wall Street Journal seemed to think it was a 50-50 chance.
I'll have to wait and see. It is Florida, after all.
It just goes to show, even with the best intentions, things can go wrong. That law of unintended consequences, right?
Yep, it's always lurking. Now, before we wrap things up, CNBC had one last interesting tidbit about oil prices.
Oh, what's going on there?
Seems like they've stabilized after dropping for a couple of days.
And why is that?
A surprise drop in U.S. crude and gasoline inventories.
So even with all this talk about peak oil and renewable energy, it still comes down to supply and demand.
Apparently so. The American Petroleum Institute, they had data showing crude stocks actually went down by over 500,000 barrels last week.
Interesting. Analysts were expecting a big increase, weren't they?
Yeah, so this unexpected drop is making people think demand is stronger than we thought, which, helps explain why prices have leveled off.
It's a good reminder that those fossil fuels aren't going anywhere just yet. We still need them.
Right. Even with the push for renewables, those traditional energy sources are still super important. And this news also helped offset some of that downward pressure on prices we saw recently.
Oh, right. Because of that potential easing of tensions in the Middle East.
Exactly. Anytime there's even a hint of less conflict in those big oil-producing regions, prices tend to react.
The global economy is so connected to those volatile areas. It's kind of crazy.
It is. Makes you realize how many different factors can influence the markets.
Yeah, predicting oil prices is like, well, good luck with that.
That's one way to put it. Well, I think that about wraps up our deep dive into the financial headlines for this Wednesday morning.
Whew, we covered a lot of ground today. Everything from Florida's accidental bank ban to those record-breaking gold prices, not to mention those massive investments in AI and all that political drama.
It's fascinating how everything is so interconnected, right? From Chinese automakers to AI's energy needs, it's a constant chain reaction.
Definitely. And with all this uncertainty swirling around, it's more important than ever to stay informed. Try to understand the bigger picture.
Couldn't agree more. We'll be back tomorrow morning with more headlines from those major financial magazines. So join us then, see what's new.
Until then, stay curious.